Hi, this is Tim Shea. I've been working at FXCM and trading Forex for a few years, and I've seen a lot of traders, including myself, make good trades and bad trades. In the process, I've learned that when you start trading, you should follow 6 simple rules. First, focus on only one or two currency pairs. When you first start trading, it's tempting to see opportunities in every pair, even ones you're unfamiliar with. When I first started trading, I tried some of the more unusual currencies, like the New Zealand dollar, Australian dollar, and Canadian dollar. I didn't know anything about the currencies, so I found myself watching news events for a dozen countries, analyzing all manners of charts, and losing my shirt in new and exotic ways. I got into trades after they'd already passed, and got hit by news events I'd never even heard of. I managed my money very poorly. In short, my concentration, capital, and time were spread too thin. Now, I watch only a few pairs at a time, and they're usually overlapping pairs, such as the euro yen, euro dollar, and dollar yen. I see trades developing much sooner, and I'm better prepared to take advantage of them, as well as manage them once I'm in the trade. As a beginner, then, you should stick to one or two currency pairs. Which ones? I would advise you to go with the currencies that other beginning traders have traded most successfully. I recently reviewed success rates for the 18 pairs we trade with significant volume, and these were the most and least successful for FXCM mini traders. Pick from column A, not from column B. Let's look at the worst ones first. The 7 deadly pairs all have one thing in common: high volatility. That means opportunities for big profits, but also large losses. One of the 7 deadlies, pound yen, is actually the 4th most popular currency among our mini traders. Its very volatility and its popularity as a carry trade make it very tempting, but it can be brutal. Here, in August 2007, it moved as much as 1,000 pips in a day. Whoever bet right realized a very big profit. Whoever bet wrong probably got a margin call. Approach the 7 deadly pairs with extreme caution, and only after you've learned with other slower moving pairs. Now for the friendly 5. Notice they're almost all euro pairs. They also have one thing in common, with the exception of pound Aussie: low volatility. But which ones do you start with? The pound Aussie has shown good results, but I still don't recommend you begin with it. It's not highly traded, not very well known, and it has rather wide spreads. Actually, it seems to be the preserve of our best and most experienced clients, which is probably the reason it shows good results. The remaining 4 pairs are much better known, and, excepting the euro yen, tend to be nicely range bound. Since these pairs have had strong support and resistance levels, they create a lot of high probability, low risk trades. And since they are very liquid, they have tight bid-ask spreads, making them inexpensive to trade, with spreads often as low as 1 or 2 pips. Of course, you might have a good reason for trading a currency pair not in the friendly 5. For instance, when I started, I went with dollar yen. Why? Simply because I'd lived in Japan for 2 years. I followed a lot of Japanese news and became familiar with their major economic indicators and events. So, I thought I had a good head start on understanding the yen pairs. As I began trading the yen, I got to know some of its price patterns. First of all was the patterns formed by the carry trade, the major factor in most yen movements. Speculators around the world have been carry trading for years, borrowing low interest rate yen to buy high interest rate US dollars or British pounds, and earning the interest differential. This trading moves the yen pairs in an almost predictable pattern. You can see it here. You can see the gradual buildup as speculators buy and increase long positions, earning large amounts of interest. Then, thud, the speculators get spooked all at once and cash out, and the price falls off a cliff. I got to be familiar with this pattern, as well as the events that can trigger the price drop. Here in February, China's stock market fell 9% in one day. In August came the big global credit crunch. Both events saw big drops in the yen pairs. That much I learned by simply watching the price charts and actually trading. But trading experience only takes you so far. To improve my trading, I had to know a lot more about yen behavior and the Japanese economy. The importance of sales reports for Japanese convenience stores, for instance. Or how during my evening hours, when it's daytime in Tokyo, an unusually large amount of volume comes from individual traders in Japan, and that they tend to be yen sellers. To really learn Forex, I started to seriously research the pairs I wanted to trade. It was time well spent, and it was free. There are several Forex information sites online, and while I might be prejudiced, I would recommend our own free FXCM research site, dailyfx.com. Not only because it's so comprehensive, but because it provides clear guidelines for trading. When you use DailyFX, you discover not only a trading chart of any currency, but when a particular economic event happens, how important it is, and its expected outcome. FXCM Live clients also have access to DailyFX Plus, which provides timely analysis of news events, what the outcome will mean to a specific pair, suggestions on how and when to trade the currency, and a clear risk profile. That brings me to one more vital point that might seem to contradict what I just said. You must monitor news events and analyze news events, but you shouldn't trade during news events, especially the ones that rattle the market, like GDP and employment releases. The fact is that during news events, trading can be as capricious as rolling dice. In the run-up to the event or release, currency analysts will have published estimates of the outcome or the number. If the estimates prove to be wildly wrong, traders caught by surprise will often panic and take the market in an unpredictable direction, or no direction at all, whipsawing up and down, knocking out traders left and right with big losses. Here's what a U.S. employment release did to the pound dollar in February of 2007. You can see this big hundreds of pips swings up and down in the minutes following the release, as panic gripped the markets and prices moved suddenly and powerfully with little rhyme or reason. How can you predict that? You can't. So, don't risk your money trying. Instead, wait for the market has settled a bit before picking a trade. That way, you'll be with the large and responsible traders. They'll wait for the mayhem to subside before risking their money, and so should you. Another reason to avoid trading during news events is that liquidity often dries up and spreads widen, which means that getting in and out of trades can be very difficult. It's much better to wait for a few minutes, since liquidity returns and spreads tighten again pretty quickly after the event. My final tip for today, realize that you will make bad trades, and plan accordingly. Trading is a constant learning experience, and you will want to make sure your early education is as inexpensive as possible. So, trade small and keep your leverage small until you've got the hang of it. Then, make your trades bigger. The best way to start trading is to open a mini account. It lets you begin with as little as $300, and if you open before the end of this course, we'll rebate you the course fee. So in summary, start with only one or two pairs until you get good at them. Choose good, low volatility, low spread pairs to start. Make sure you choose a pair you're comfortable with. Do plenty of research to learn your pair. Do not trade during news events. And start